This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's Thursday morning. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleague Sonia and Nigel. Guys, hi, morning.
Hi, Prashant. Morning. Nigel, morning. Well, I missed you guys yesterday, but I think the market missed you more. Look at what happened in just one trading session, right? There was a big fall, but be that as it may, we've seen many such falls in the past, so perhaps no reason to panic. But let's see, today is going to be an interesting day.
Well, that's right, and everyone talks about the Santa rally, but people forget that between 20th to 30th, normally you see that one shakeout that takes place. Yeah. So maybe we're done with that turn. So hopefully things look up from here on.
Hopefully, fingers crossed, right? So let's just quickly rewind the clock back and begin by telling you what you need to know as we begin another session. So big sell-off yesterday, and it's a large bearish candle. The reason why it seems large and it seems kind of ferocious when it came yesterday is largely because one is not used to it. I think that's very important to remember. The market's been moving up non-stop, and to see a near 1.5% cut, I mean, that just seems very outsized. I mean, 1.5% is not small for a single day, but the point is, I mean, usually you've seen 1.5% moves, but on the other direction and not on the downside. In any case, we got a large bearish candle. There are lots of theories about what happened yesterday. I mean, I heard people talking about resurgence of COVID cases in Kerala, exposure margins being increased for F&O stocks, the RBI, AIF thing, etc., etc. A lot is going around. But I think at the very heart of it, the fact is that the market had been very overbought. And this RSI number we've been putting out for the last couple of days, RSIs of more than 80, 85 for many days in a row. The problem, I remember the last thing I said day before yesterday when we wrapped up at 3:30, well, the problem is that the price was not showing you any confirmation that, it basically wants to cool off. Yesterday, we got that for the first time. And I think that is the simple kind of explanation, if you're looking for one, for the shakeout that we saw in trade yesterday. So price action so far had been defying gravity, but yesterday we finally got that track. The question for, I think, everyone is that in the very near term is a short-term top in place. I mean, in the very near term, it's a question I think one must consider. And how do you answer that question? You'll have to answer that question based on, levels, etc. If they break the 20-day, etc., comes to mind. I'll get to sort of levels here in the Nifty, Bank Nifty in just a bit. But keep in mind that the last 15 days of December, if you go back the last sort of 10, 15 years, are typically very quiet. They're positive. I mean, 0.5%, 1%, 1.5%. The average, I think, would be about 1% higher. But the last 15 days of December are typically extremely quiet. And then there is January seasonality as well. I think, in more number of cases rather than not, January typically is a bit of a weaker month for markets as well. At least, I mean, I saw numbers since 2010 or so, and that kind of holds well. So you're essentially looking, and this has got nothing to do with but the fact that, people go out on holidays and they're away from their desks, right? I mean, especially on the global side with Christmas, etc., coming through. So there's not that much activity. Activity thins out typically this part of the year. So, you got a crack off of extremely overbought levels. The market got a sort of a drop yesterday, both on the Nifty and the Bank Nifty. The mid-cap and small-cap sold off more. And now you're heading into a bit of a seasonally weaker and quieter part of the year, at least for the next 30, 35 odd trading sessions or so. So keep that in mind. Now, I'll come back to levels, as I said, for confirmation, whether that question, short-term top is in place or not, to answer that in just a bit. But, just overnight, something interesting happened, right? I mean, if you're watching the U.S. markets, I was not, through the night, but I saw this in the morning and I looked at the intraday, what happened. Absolutely stable trading, and then mid-afternoon onwards, the U.S. market sold off. No real reason there as well. I mean, you can find reasons. The S&P was down 1.5%, the NASDAQ was down about 1.5% as well. And, many are attributing this comment from, Fed's Harker, who's a voting member of the FOMC. He basically voiced concern that the economy is slowing faster than the data suggests. Basically, he's saying that anecdotally, he's feeling that the economy is slowing down much faster than data suggests, because data actually suggests otherwise. Data is still strong as we close 2023. So, for example, yesterday we had the consumer confidence numbers, which beat expectations. But here is someone who's a voting member of FOMC who's saying that, well, look beyond the data. And he's feeling that the economy is actually slowing much faster. And the market did not like it. Yields actually sold off. Bonds rallied. So 3.85 on the US 10-year. It was down about 8 basis points or so. So again, I mean, the US as well, actually, all across, especially in the US, I think we are in a bit of a confusing kind of a zone. We find ourselves in a bit of a confusing sort of zone. Let's just circle all of this back to the Nifty, the Bank Nifty. I think very simply put, you look at the 20-day moving average. I mean, I think the hourly averages which we've been working with on a trailing basis, of course, they're out of the window now. For the Nifty, 2681 is the 20-day moving average on the Nifty. And that is the first level which the market will sort of test, will try and test to see if it wants to break below it. You want to, I mean, to confirm downsides, you want a sort of bigger close, a solid close below it. We're not there yet. It's different for the mid-cap and small-cap indices, which are already almost there. I mean, look at yesterday's close and look at the 20-day moving average. We're there. I mean, not even a percentage point in both cases, right? And the thing is, if the Nifty mid-cap and small-cap indices close convincingly below the 20-day, I mean, that's the broader market. It's very unlikely that the broader market remains under extreme amount of pressure and the large caps stay and keep their head above water. So I think this will give us a fair bit of indication before what the Nifty actually does. Again, I mean, those levels will be important. And as I said, a decisive close below the 20-day will set the near-term trend. The Nifty Bank has got two numbers on the downside to watch out for. 46,887 is the first level, 46,887. We left off at 47,445. This was the recent swing low. And then the bigger support is, again, the 20-day for the Nifty Bank, which comes in at 46,174 out there. The GIFT Nifty will come up on your screen. I mean, the indication is it's going to be a flattish kind of start. Let me say this. There is no, and I've been saying this consistently, there is no reason to, or there was no reason, and there is no reason to chase the market higher. I mean, the risk reward is much more in favor if you actually buy at lower levels. And lower the levels, the better the risk reward on your side. And I think that setup really does not change. But bear in mind, if you're trading the next 30, 35 odd days or so, I mean, that bullish kind of tailwind that markets had, bulls had, that perhaps will be missing just because of the fact that people aren't there. And I mean, the activity is essentially going to start to thin out as we head into the end of the year or so. So if you're trading, I mean, the recommendation is pretty clear. Be cautious. And you don't want to muck up the profits you've already raked in 2023 by kind of, holding on to pure momentum kind of movers, which can sort of give in and give back gains very quickly if the market actually starts to break some of these levels, which I put out earlier on. Sonia.
Okay. Well, I mean, you almost said it all. Like, it's basically profit booking, right?
Yeah.
That's what we saw in trade yesterday. So for people who are getting a bit nervous about that one-day fall, all I can say is that we've seen many such falls in the past. It has been a big rally that this market has seen. And after that, some give back is very, very normal. But what happens from here on? Remember, yesterday, the Bank Nifty was down almost 500 points. The mid-cap index was down about 3%. And the fall actually came in late trade. So that's where I think the surprise element came through. So people knew that there was some profit taking expected, but the ferocity of the fall is something that I think no one expected. And as they say, markets take the stairs up and the elevator down. So that's pretty much what happened yesterday. But let's not forget that the Nifty is also up 2,500 points in the last 6 months. So a 300-point give back would not really harm anyone. The FI has also become inactive generally in the last 2 weeks of trade. So, you want to keep that in mind. Yesterday, in fact, FI sold about 1,300 odd crores. I'm watching out for a couple of things today. One is the Inox India listing. It's expected to be a very strong one. Remember, the issue saw a very strong subscription at about 61 times. So that's something to keep on your radar. Also, the US markets were weak. So maybe we preempted some of that sell-off. You never know. The Dow Jones, after it was down about 500 points overnight. But just putting it into context, right? From the October closing lows, the Dow is up more than 15%. So some amount of give back really won't harm anyone. Data to watch, there's jobless claims on Thursday. There's Q3 GDP data as well to look out for. So plenty on the market's hands. But for now, I think it shouldn't be too much of an issue, the sell-off that we saw yesterday. You can't really call it a correction, maybe a pullback at best. It could extend itself for a couple of days, but nothing to be worried about.
Well, like the Indian markets, even the US markets got nervous in the last 2 hours of trade, actually. If you looked at it till the last 90 minutes or so, the markets were holding, US, the Dow was holding at around 37,500 and it ended closer to around 37,000. So that's a 500-point cut that you saw. just in the last 90 minutes in the US markets as well. How's trade set up? Well, global clues are a little bit weakish. The Nifty weekly expiry will play out today, and you have support at around 20,900 approximately. So that's going to be the important level I'm looking at the downside. As I've been saying in the last few days, maybe in the near term, the large caps could be in for an outperformance. That's on the upside. So on the downside, if you're going to see a correction on the Nifty itself, then I'm expecting the mid and the small cap space to come in for a harder knock. Some of these stocks will provide very, very good entry opportunities, but the index itself has run up a fair deal, so maybe we'll see some bit of profit taking out there. The Nifty, well, in fact, we're getting rid of that December phenomena that I was talking about earlier. Every December for the last few Decembers, we see either a 1.5 to around 3% cut on one particular day. It appears that phenomena has been taken care of, at least as of now. What did the FIs do? Well, they added long positions actually. They added close to around 18,000 long contracts, and now the long positioning moves to around 65% approximately. And the long positioning in absolute terms, well, that's the highest we have seen in the last 5 months or so. So the net long positions are at around 85,000 contracts. At the start of this series, that's towards the end of the November series, we have seen a swing factor of close to around 2 lakh contracts, because they were net short by around 115,000 short contracts. Now we're net long by close to around 85,000 contracts. And the last time we were this net long was in July 24th, 2023 itself. And from there, the markets did see some bit of a correction. So you don't want that number to go to around 100,000 contracts we've seen in the past. Then that gets too easy on the long side. So we'll keep an eye out on that factor as well. Yesterday, the markets did see a correction in the 21,300, 21,200 call. Between them, they added more than 1.5 crore shares. So aggressive writing is what we've seen on the call side. And because of that, the PCR that was at 1.472 sessions ago, that's come down to around 0.66. Normally, when we see this number of around 0.65 odd, we see the market see a bit of a bounce. So the PCR has come to the lower end of the range. So let's get you the levels then. The 20-day MA, well, that's a 500 points or so away from current levels. But just going by the options data, the near-term support is at around 20,950. Resistance will be around 21,500, because we went there numerous times, but we couldn't conquer that decisively. And the 20,950 level I'm looking at, because the 21,000 put has the highest open interest on the put side. On the Nifty Bank, that's going to be very, very important. The 47,000 mark should hold out. If that breaks, then you look at the 20-day MA. Even yesterday, though, you saw a relative outperformance coming from the Nifty Bank. So there is a fight back. I'm expecting the Nifty Bank to lead the way. The GIFT Nifty suggesting a bit of a downtake. Well, if you have, if you believe that this market is going to move up from here after yesterday's correction, then you keep your stop loss at around 20,950 and you play the long trade. But let's see how it goes. The broader markets, I'm a little bit more concerned out there because the run has been such.
Absolutely. And, we have a lot of opinion coming through because of what happened yesterday. So let's get straight to it. What do you do now after the fall that the market has seen yesterday? Gautam Dugar of Motilal Oswal says, some profit booking is seen after a big rally. He says a 1,000-point fall on a base of 71,000 on the sensex is not even a 1.5% fall. He adds one slight jolt does not change the trajectory of the market. And he says they will look to buy the dips in the large caps, but they are a bit wary of mid and small caps at the moment.
Okay, Dhaval Dalal of Edelweiss Asset Management weighs in on bonds. He says yields are expected to remain range-bound with declining buys and positive sentiment and sharp fall in developed market yields. He says tight banking system liquidity and expectations of a shallow rate cut cycle in India and H2 of FY25 are likely to temper sharp fall in yields. He expects the 10-year benchmark bond yield to trade between 7.15 to 7.25% in the very near term.